It's time to down tools for a bit. Welcome to the ToolShed, the influential podcast for anyone and everyone involved in the building industry. Here's your host, Mick Hawes.
Hey there, before we kick off, I want to share a really important thought. 71% of you who watch this channel frequently don't subscribe. So if you've enjoyed any video you've ever watched, can you do me a favor and hit the subscribe button? It helps the channel more than you think, and the bigger the channel gets, the bigger the guests get. So let's go. Welcome, Mr. Tran, or otherwise known as Terry, friend of the podcast, friend of Black Belt, been on the Toolshed a number of times. I suspect, though, there is a possibility that somebody listening to this hasn't seen you on the podcast before. This is the first time they've listened to it. So just real quick, how did you get involved in what you're doing now? I just love this story of the migration and the challenges and how you rose above it. And to me, it's very, very inspirational. So please share that story again.
Sure, Mick. Just very quickly, I've been in the country pretty much all my life since I was the age of 2. Came as a boat migrant, one of those original boat people where our boat never made it to the country and it sank offshore, ended up being rescued by an oil rig, and ended up on an island for about 6 months until Australia, the lucky country, accepted our family into the country. Unfortunately, my father did pass away on the island, and then raised by a single mum, and just saw how my mum struggled financially over the years. And that drove me to not only, obviously to try to do better and financially support her while, as I was growing up, but also going to the corporate environment, making some money, making sure that I can look after her. But after a number of years in the corporate role, I was getting, a bit annoyed that I could do better in life. And therefore I started the investment journey, firstly in property, and then because I was in banking with the NAB, and then ended up into the share side because I just found that it was faster growth with far less leverage and far more liquidity. And so in short, been investing for almost 30 years now, 15 years managing other people's money, and the last 10, which is time flies, the last 11 years, 10 years plus, we've been now educating Australia, a lot of students around the world, and also New Zealand. And we've got well over 2,000 plus students that have gone through our program and just really enjoy what I do and want to share that message of, you can make very decent returns, but also do it in a safe manner as well. So, so that's the crux of it, Nick.
And, from my perspective, it's so important to educate yourself. But like I find this in business coaching, I find it in coaching for real estate investing and also share investing, that there are a heap of people out there that have great social media and tell a great story, but the majority of the money they make is selling you their course rather than doing what they say or what they're going to teach you to do. And I know that, having met your people, I know you extremely well. We're great friends, and having gone through your program, which is so detailed, and it's focused on the right things. It's focused on protecting the capital. It's not risky whatsoever, and I just think that's so important. And my personal experience, like some years ago, and I want your thoughts on how important it is to have somebody in your corner. Like, we did some real estate deals over the past number of years, and fortunately we did pretty well out of buying this, and I was telling myself, I think that there's some growth in this area here because of this, that, and the other. And then sometime down the track, I did engage a wealth coach that was specifically in the real estate area, and I started to learn some stuff, and I realised everything I'd done in the past was just arse. Like, it was just dumb luck. But it's so easy to hypnotize yourself in thinking that you know what you do. And I hear a lot of people talking to each other, both of them are sitting on the bar stool with their ass out of their pants, coaching each other on financial decisions. What are your thoughts on all of that? How important is it to have a relationship with someone who knows what they're doing, but also you trust and get along with?
So important, Mick. You hit it now on the head. It's literally so important, because I used to be like you when I started at 17, 18. My first couple of years was actually very good by, again, dumb luck, where I ended up making quite a fair bit of money. Trying to, as a young, I guess, teenager, first job income was coming in from a full-time job. And I started doing a lot of risky stuff like the options, CFD trading, things like that. I just want to get rich quick. And I did well for the first 18 months, 2 years in. And then ended up a sizable market event occurred. And literally overnight, all the profits I made, which is about 100 grand going back almost 30 years ago now, was lost overnight. And that then sort of slapped me across the face and to let me know that I knew nothing. It was about 3 years worth of salary at the time. And then I realized it was really just dumb luck for those first 2 years that I made that money, but ended up losing more plus more. And then realized that I needed to finally get proper education. And I did go through, like a seminar junkie, every single thing that was out there, seeing what's out there, learning from what you said, people who also taught for a living and not actually doing for a living. But then ended up reaching out to the great legendary Warren Buffett. And at that time, I was probably the first one from down under to actually reach out to him via a 4-page thank you letter. And that got through the doors from his PA. And then surprisingly, within 2 weeks, he actually wrote back to me. And that opened the doors to not only himself, but also a number of world-class fund managers that were willing to have lunch and have coffee with me to actually learn from these guys. So the people who now manage the multi-billion-dollar superannuation funds, they were now in my corner having lunch and having coffee with me because they saw that desire that I want to learn. And they were sharing, I guess, in a way, their secrets informally. And that's how I learned. I learned from people who did for a living and not just taught for a living. And their really focus was so important. It's not about the returns, but risk-adjusted returns, where you make decent returns, but however, doing it in a way where it's almost like the risk is so low that you're almost like guaranteed that return. But I mean, no one can guarantee it, but it's so consistent that they are making returns, but at any point in time, they will never lose the fund, which of course is their investors' money anyway. So that showed me the importance of risk management versus just making money, which is what a lot of people focus on.
Yeah. You can't predict the future. You can't guarantee returns. But there are things that we can look at that sort of sway the focus to cause you to think, this is a good time. This is a time we need to pull our head in and protect ourselves. It seems over the last little while, your thinking is a little bit cautious. Can you tell us what's behind that thinking? Like, in the past, we've talked about, we need to prepare for slow periods before they get here.
Yep.
Are you starting to talk about that now? And if so, why?
Oh, in a big way. It's because over the last year alone, our returns plus our students' returns was roughly about 17% per annum, non-leveraged. And the last few years, the year prior to that was, I believe it was 28%. And then the year before that was 32, 33%. So we've had really good years, double-digit, 15, 25% plus type returns for almost 5 years straight. And although the market has also had bumps along the way, like COVID, for example, we were able to not go through that period as well because of our systems. But then now it's come to a stage where we can see valuations so stretched where there are public companies. Because ultimately, what's important is that for investors, you always have to remember that stocks is not, stock codes or stock charts. Or and stocks, by the way, when I say shares and stocks, it means the same thing. It's just that US, they use the word stocks. Australian, we use the word shares. But then we need to see these as real businesses, like many of your listeners who run their own business, and they've got financial numbers. But what I'm seeing now is that a lot of these publicly listed companies, they're selling at 30, 40 times earnings. So what that means is if a company is making a net profit of, say, let's say $1 million, they're now selling at 40 times earnings or 30 times earnings, $30 to $40 million. And on average, over a long period of time, the average is roughly about 15 to 20 times earnings. And that's been the average over the last century. But yet now they're selling at double that. So what that means, and gives me that intention of saying that the market is definitely overvalued in a lot of different sectors, and it's due to all that talk of the technology sector, the AI, that no one's, of course, we can't escape from that at the moment. It is changing the world, and it's just all the hype around that so much spending is going there, and lifting the entire market up. And I can just see that the market, especially the what we call the Fortune 500 index, which does represent the world in a way. It's just been topping out for the last 3 or 4 months. That every time it reaches a certain level, it comes back down, goes back to the same level, almost like a yo-yo effect. Comes back down again. So that's happened 4 months in a row already, and that's very rare. So hence why it's coming to a point where there will be some seismic market catalyst event that will, any bad news that will continue on, that's going to definitely down a track, pull down the entire market, but in a much more prolonged period of time. So that's why I'm very cautious, because I can see overvaluation, hence why we are selling down ourselves. And I wanted to make sure that that message is reached to even your audience as well.
Yeah. What can you help us understand about the effect of global politics on the share prices around the globe as well? Because different people will have different pessimism versus optimism, pretty much based on what cable news networks they listen to. Like you can listen to a very left-leaning or a very right-leaning news service, and even the public broadcasters, our own ABC, they're very leaning one way. They're not neutral anymore as they should be. So if you keep listening to the stuff that you believe in, like you end up being in this bubble, and you just look for the proof to support your current beliefs, and everything everyone else says is bullshit. But what's going on now from your perspective that is potentially going to create a shift in the value of things and share prices, etc.?
Yeah. So everyone has their opinion. Myself, I've got my opinion as well, based on what's happening in the media. One has to remember that, though, is that to not get too sort of bubbled thinking as because of the media that we see. So what I normally do, even though I've got an opinion, I prefer to look at data. So, however, having said that, though, my opinion is that based on what we've been seeing with what's happening around the world with President Trump and all the dilemma, that it just seems like every single day there's some form of news where he's just shifting away from all the 80-year ally agreement that he's had, with the world, really, and also making a lot of enemies with not only the world but also a lot of the allies that have helped the United States. So I think over time, there is going to be a shift in the power of the United States, because trust is being eroded over time. Because, like one says, it takes many years to, easily 20 years to build a reputation, but a few seconds to actually ruin it. And I think that is getting ruined. Will it be long term? Only time will tell about that ruining of the relationships. But at least in the short term, I do see that all these events has eroded the trust of the United States being the protector of the world, but also the dominance in the US dollar, etc. And that's shifting over to some of the other nations like Brazil, basically the BRICS nations, Brazil, Russia, India, China, etc. So it is going there. But having said that, I still look at the data, and I try not to let the news and the headlines sway me, because if the data tells me it's still okay, we will continue on cautiously, though. We'll still continue investing and trading on things that are understandable on our terms, but also they fit our criteria, and they're still low risk. So if there are pockets of opportunity where some sectors or some industries and some shares are on sale, we'll still go there and still invest and trade them. But of course, sell down the things that are overvalued. But we don't stop everything we're doing just because of the media. So we allow data, the global data, to actually show us, is it still safe to invest? And that's part of actually our trading. If the data still shows it's okay, we'll continue on. But the moment that the data is saying that there's something wrong, we don't care what people say. We are looking at the government data that's coming out, but also the flow of money, which you actually can see. what are the big super funds, the big pension funds, what are they doing? Because if these guys are definitely starting to sell in a big way, they're supplying the market with a lot of shares. That means that there's only one way the place, share prices will go. It basically means going down if these guys are selling. In other words, supply outstripping demand.
Yeah.
So that's what I look at.
One of the things that I experience, going through your program is you obviously learn how to read all of the data that you were just talking about. But there's still a great deal of mindset involved, like mindset management, emotional management involved. And so one of the things that we can do in your program is we can see what Terry is doing. What actions Terry has taken. So we can look at the data and we can go, I think that's the right decision to make. And then we can check and see whether our decision agrees with your decision, which gives you a bit of confidence, obviously.
Yes.
What are you doing at the moment? And I ask that from the perspective that, again, it's easy to get sucked into, you mentioned AI and AI companies, and people will just naturally assume that any sort of company that is building AI or what have you, let's get on the ground floor, it'll be another Apple, that sort of thing. What are you doing at the moment? What have you done in relation to technology and AI as far as buying, selling, sitting? What's the story?
Yeah, so with myself, my own portfolios plus our students' portfolios, we've benefited from the last few years where we've been investing in these AI and technology companies, where the ones who the services that we both use, and I'm pretty sure your listeners use, like the likes of Google, Meta, which is Facebook, and Google owns YouTube, and then we've the Apples, which of course half the population has the iPhone. And also a company called TSMC, which is Taiwan Semiconductor, which pretty much dominates the world with the microchip manufacturing process of the most advanced. About 80% of all the chips around the planet is made by these guys. So all those companies that we've bought in a number of years ago, 3, 4, 5 years ago, they've gone up by 400-500%, and we've benefited from that. However, what I'm now seeing is that even these companies, they're now getting overvalued. So we've been not selling out, but pruning down, so lightening down on positions, because we've made that much money. We also want to lock in our profits and not let the profits evaporate. So we've been selling down, personally myself. And then what I'd say too is forget about the hype of these. You mentioned about some of the companies that go into AI and then they're splash across social media, etc. It's okay if they're across social media, but the one thing that we need to do is first is to check their figures, the financial figures, because in the end, they're a business. And most startups, if they don't have a history of at least making some money and also have a history of management looking after their shareholders' money, where they've got no data at all, myself, plus I'd say your listeners should be letting go of those type of companies. Where you want to focus on more is just going to the larger companies that at least have a history. Like, for example, Google, Microsoft, these guys are spending a lot, and even Meta recently, a couple $100 billion each on building the AI infrastructure. But it's okay for these guys to spend the money because they're actually very profitable anyway. So despite the spend, they can afford to that spend. And even if it doesn't work out, these companies will still survive. The one thing that you want to avoid is the startups that have no history, but they're raising capital from would-be investors that hope that it's the next Apple, but they have no history, and they basically are spending shareholders' money, hoping one day they'll make a profit, but you don't know. There's no end in sight. And if every time they start losing money or they run out of money, they just tap the shareholders again for another capital raise, and again, the shareholders have no choice but to either put more money into it or they get diluted by new shareholders. So we want to avoid those ones. So that's what I look at. I need to make sure that big or small, they need to be profitable as a business first. And if they spend in AI, so be it. That's great, because at least they're building the infrastructure for the future, profitable growth. But then if it doesn't work out, they've got a plan B, because their plan B is their already existing very profitable business model anyway.
Yeah. I know that we've talked about this in previous conversations on the podcast, but I just think it's such an important point to make just around the mindset. So one of the things you mentioned in the answer to that last question was that you weren't selling out completely. You were just reducing exposure, and you wanted to make sure you were taking the profits. And there is a whole minefield of mindset that needs to be managed around that, because when the share price goes up and you have quote unquote profited, you haven't really. Like it's just on paper, and people get very optimistic when that happens, and then if it starts to go the other way, they get very pessimistic, and it's like a hot potato, get rid of it, and all that sort of stuff. Can you just elaborate a little bit on the importance of learning how to manage your thinking and your emotions around these things, because it is easy to get influenced by the guy sitting next to you, or the streaming service you watch, or whoever you tend to be influenced by. But what I love about what you do and how you do it is the emotion can be, as best as possible, taken out of it completely, and you're just looking at data. It's emotionless, and it's like the old, Little Britain, the computer says no, and that's how you got to make the decision. Can you elaborate on that? Because I think it's just such an important point.
Yeah, no, really important, Mick. Because what I try to train people is the best investor that you can be is if you can become robotic.
Yeah.
Therefore, there's no emotion when you make money, but also no emotion when you lose money. And one thing to do is actually one thing I always say too is investing and trading should actually be boring. It should not be exciting.
Yeah.
When someone says that, I get excitement from markets, like go get excitement somewhere else. Go on a roller coaster. Go skydiving. Don't get excitement from the markets, because you can get that at a casino and then lose a bunch of money and then come home very sad, for example. But don't get excited by the market. It should be boring. Should just be a process. So that's why I think one way to get rid of that emotion is to have a very process-driven, almost like a checklist. Same as you too, Mick. When you're buying property, there's in your mind, whether you do it on paper or in your mind, that there's a checklist that you're going, is it a great suburb? Is a street good neighborhood? So you're ticking all these boxes in your mind anyway. So shares is no different. It's just another investment class. So a checklist or process should be available and should be there. So that would get rid of that. But also having the process of risk management too is like, if you find a great investment, doesn't mean that you just go all in. Even if we find a great investment, there's a thing that we use called position sizing. So what that means is, unlike property, where a property is quite a large purchase. It might be $500,000, $1 million. You're borrowing 80-90% from the bank, and literally that's all you buy, $1 million or $2 million, or $500,000, and it's one house, and that is it. Whereas shares, you can diversify. So even though we diversify across the portfolio of shares, sometimes 20, 30 different shares in a portfolio, within the stock itself, we tiptoe ourselves in. So the first purchase you buy might be only about, depending on market risk, might be 0.5, 0.5% to 1% position of your portfolio. So you're slowly buying the position. So what that means is that when you translate into percentage wise and not dollar wise, because 1% of the $1 million is different to 1% of the 100,000, for example. So if you do it into percentage wise and also have very small bites of the cherry, even if you like it, then you minimize the risk first of all, but also you get rid of the psychology of, should I do this? Shouldn't I do this? So because if the position is so small that it's not that you'll lose it all, you can't, because if you're buying the likes of Google and Apple, to lose all that money means that whole business has gone bankrupt, which you won't. But can you buy at the wrong time? Potentially. Yes, there's 80% of the time we'll get it right, timing-wise. 10 to 20%, the timing might be off a little bit, but it's okay. Eventually, we'll go back up anyway. So we want to even protect against that. So when you position size so small that amount that you've put in is inconsequential to the entire portfolio. So then it allows you just to click on the mouse, buy it or sell it without overthinking it. In other words, analysis paralysis is taken away from that. So then you don't have that sort of hesitation of decision-making on either the buy or the sell. And therefore, again, on the profiting side that you mentioned, if you get to a stage, and we've got these rules as well, when something that you've held for a while, long term, even if you've made hundreds of percent, but now if that stock is, let's say, is really only worth about 300, but that stock has now gone up to 500. It's like a house that's worth $1 million, but someone's giving you 2 million. You really should take this money off the table. So we've got a rule that, if something gets overvalued by 20, 30%, you might want to take some money off the table. So that's, again, part of the process, again, is that when it does happen, you don't hesitate. You just have to follow the rules and do so. And reverse, the same with selling. If you bought something, but now, even though since you bought and it's come down, but the financials on a quarterly basis or half-yearly basis, when they come out and you can see that business declining, then even though you've made a bad decision, our process should still stick, because even if it means if you have to take that small loss and then move out of that stock, you should still do so, because if you don't, potentially get worse, because a lot of people, when they buy something, it's easy to sell something that's at a profit. But what I see is that people are very reluctant to sell also at a small loss or a loss, because they just can't bear the fact that they've made a mistake. But that's all part of the process anyway.
Mm. So just on that, would it be fair to say, and I'm more than happy to be told I have no idea, which is why I'm asking the question, it seems to me that what you've just said is we've got to take the emotion out of it to make better decisions. But would it be fair to say that the reason that the share market does go up and go down and change is fundamentally through emotional decision making by the majority of small shareholders? That's what makes it go up, and their sentiment is, this is going bad, but we'll hold on to it because it'll turn. Oh my God, we've got to get, we've made such a big loss in this, we now have to sell it. And then the opposite. We've seen this go up and up and up. And we're missing out, and it's going up and up. And so they buy at the top, they sell at the bottom, which is the opposite of how you're meant to do it. Am I thinking that correctly? It is poor decision making and a poor emotional management that makes the share market go up and down in the first place.
Yes. And there's that quote to Mick from the great Warren Buffett. In the short run, the market is a voting machine, but in the long run, it's a weighing machine. So that's that quote that I've always lived by too. And it is correct what you've said, because it's for small, especially small illiquid stocks or the small companies, they're definitely affected more by the mums and dads or the private investors that are out there, because a lot of institutions aren't usually interested in those type of stocks. They're just too small for these super funds, and they're also too risky. But on the other hand, there's also the institutions, which they are ultimately, even though they're a company like an NAB or a big fund manager, in the end, they're still run by people. And those people still have emotions. So despite them being an institutional investor, they're still humans behind the desk that make those decisions. And they're measured on a quarterly basis. So their job also relies on them performing well. So when things don't go well, they're also emotional as well, and can be emotional. They do have, of course, they're slightly better because at least they have a process. But when things do fall off the tracks, those same people that run the institutions, they also get emotional at the same time too. And the last thing they want to do is lose their job. So therefore, that emotional roller coaster happens for both the private investors and the institutions, which are made out of people. And that's what really causes the up and downs of the market. And it's for us to now sit back and look on the bigger picture with our process to know, is this point in time just a temporary panic that these guys are panicking for no reason, therefore it's now cheap? Or are they actually panicking for the right reasons? And despite the stock dropping 30, 40%, it's actually still expensive. Therefore, you should still stay out of the market as well. So having that process makes life so much easier, because you can then focus on the actual fundamentals of the share market, the share itself, and not be dictated by all the news, the media, social media these days, and things like that.
Yeah. And I've found exactly the same thing, in real estate investing as well, that like having a coach and having someone who really understands the data. And I couldn't believe the depth, like when I went through your program, the depth at which you look at things is amazing. And it works exactly the same with the real estate market. you get into, and it's not a feeling, it's data, and you're looking for the appropriate data. You're matching that with your risk profile and all of that sort of stuff. And for the very first time, making a real estate purchase that had a zero emotion attached to it was a great experience. Like every other time I've bloody hated it. Like you're panicking, what's going to happen? And you just take all the emotion away from it, and the right decision gets made.
Definitely.
A little minute ago, you said that many of the tech and AI companies are trading at sometimes 30, maybe even 100 times earnings, and they're kind of areas to be cautious about. What areas are you currently seeing opportunity in?
Funny enough, Mickey, it's actually also for some reason in the past month, they're back into the tech side where some of the likes of the big tech, where because of AI, although they're heavily invested in it, the bigger end of the picture, now they're saying that, at one stage where the stocks were overvalued, but even the likes of Microsoft, they've come down by about 25% in the last couple of months. And now they're actually quite undervalued. So we are seeing value even inside the tech stocks, because at one stage we were lightning down on the Microsofts, the Googles, because they were overvalued.
Yeah.
But then having all that cash come back into the coffers, we're seeing the same shares that we sold out, they're now back down by 25%, and now we want to go back into them. So a lot of these software companies, the likes of Microsoft, Adobe, all those ones, I'm seeing opportunities there. And then there's also not as much now, but going back, the last podcast we did about 6-7 months ago, the pharmaceutical was very cheap because everybody was chasing AI and tech. And they were, obviously money has to come from somewhere to go into that sector, because it's just money moving around. And those sectors like the pharmaceutical, they were sold off 6-7 months ago. Nobody wanted it. But since that time, they've gone up, and I'm talking about the large end of town, the Mercs, for example. They've gone up by 30-40% in the last 6 months. So, but are they now cheap? They're still okay, but they're not as cheap as what it used to be. So I would probably avoid those ones. But certain parts of the market, like the retail, they're still being sold down. And so we're going there, but only very selective few that have great financials. And they need to have great financials, because if they don't have great financials, it's so important that they do, because if at any point where we down a track, the market drops, economy is going to recession, they're the companies that need to be able to survive, because if nobody's spending, those companies will be the first to be hardest hit. But if they've got very strong financials, they can actually weather the storm. And if they are able to weather the storm and you're able to buy those stocks at a much cheaper price, they're the ones that will actually benefit the most as well.
Just heading back to philosophy again, a quote that popped into my mind, and I've heard it many, many years ago and heard it very often. It was from Walt Disney. And he basically said, and I think I'm paraphrasing, I don't think this is an exact quote, but he said that if you want to be successful, look around and see what the world is doing and don't do it. And I've heard you say, be greedy when others are fearful, and be fearful when others are greedy. How do investors know when to shift gears, change their mind in relation to what should I be doing right now? Like, how do you see what everybody else is doing so you can not do it?
If you take taxi, or these days take an Uber, for example, and the driver says you got to buy crypto, then you know that there's something wrong. Or you have to buy shares or do certain things, then you know that it's actually reached the entire public now. Yep. So that's definitely one.
Yep.
And I would say that it's probably also the news as well. Like you just see so much, like you said previously, every single news outlet at the moment, they're very left side or right side. And if you just see that, all that, it's always about bad news, and it's panicking the world. You can see that slowly, or even hype up about technology. You can see that everybody's onto that train already. And it's by the time you get on, it's already probably too late. And that's where I'd say it's the media and social media that you can see where is the world right now based on what everybody is talking about on those channels. But also at the same time, when you go to dinner parties, barbecues, etc., with family and friends, if everybody's talking about a certain thing, then you know that something's also wrong too. So that's how I in a way gauge it. But of course, there's also some tools out there which allow the public to actually see where is the what they call the fear side and the greed side. There's actually indexes that also show that too, and they're free tools out there that allow you to see that too.
So moving forward, can we talk about what potentially could be an action plan for somebody listening to this? And I'd imagine that they're probably split on one side or the other of self-managed super funds or a managed super fund. What might you encourage people to start to think about as far as an action plan moving forward with the way things are at the moment? And is that different if you've got a SMSF versus like a managed super fund?
Yeah. Great question, Mick. And I think this is actually quite going to be very important for a lot of your the viewers out there. Is for those who are already running self-managed super, and whether you're investing in property or especially invested in shares, like I said, the market is getting it's topping up and it's getting very overvalued. And it eventually, it's not if, but more when in 2026 that there's going to be a major market pullback. So if you've got a self-managed super fund, you are in control where you have direct shares, you can easily sell it. Unlike property, of course, selling shares is very easy. You log in, few seconds, with a click of a mouse, it's gone. Money's in your account the next day. So the speed of that sale and also or purchase is very quick, and that change. So self-managed super fund, you've got control. Where I see the potential issue is for those who don't have self-managed super and you're invested with an advisor or with someone, or even you've done it yourself, or your company has done it for you. If you're working for a company, or even your own, if you're a business owner, but you've just made sure that you pay yourself super and your partner super, etc. It just goes to a managed a managed super fund. So if you've got that, what you probably need to do, I'd say the action step is to contact them. Firstly, which is what I find quite surprising, get the latest statement. A lot of people don't even know what they have in super. So definitely check that out first. Also find out not only how much you've got, but also find out what fund do you have. Is it a growth fund? Is it a balanced fund? And when I say growth, it means that majority is in growth assets, where they'd be in shares, in both definitely not residential, but more commercial and industrial property. And bonds, for example. So there's always going to be a mixture. But if it's a growth fund, it'll be more shares, more property, very low cash, very low fixed interest bonds, etc. But on a balanced fund, it's definitely more spread out on that term. So therefore, the risk is lower, but also the returns are lower. So find out firstly, what fund are you at, and even look at the returns, because you'll be surprised. It's probably almost like a good reset to say, oh, far out, the market's done this well over the last few years, but my super's underperformed all these years. What's happening? And yet I'm paying fees, etc. So you're actually double. Not only are you underperforming, but they're also charging you fees. So maybe have that reset. Oh, am I even in the right fund? Because I feel like I'm paying for nothing really, where I could have gone into an index fund and got better returns, for example. So find out the past record, and then also find out, and this is probably you need to actually ring them now, is find out if I want to switch, how do I switch? What's the process? Is it as easy as just filling out a form, or can I do it online, or can I do it over the phone? Which normally you can't do it over the phone. They'll probably send you a form. So if it's easy enough to do switches and how long it takes, then at least you've got control back. When the time comes, you can do it quite quickly. And also even potentially, could the fund have slowly switch into some cash as well? So you've got cash holding. So when bad news eventually happens 3-6 months down the track, could you then I always say cash is king at that time. Do you have that cash to then take advantage of that big downturn that we're expecting, and then literally have that as an opportunity to buy in at very cheap prices, because they will be your 30, 40, 50% returns over the next 12 months if you catch that period. Because the last thing you want to do is not be aware of this and sit as a spectator, and then all this happening while you're watching the news and just go, oh my God, my fund's just lost 30, 40%. And you've just been like a deer in headlights, just seeing it as a spectator, and you can't do anything because you never took those steps to actually do so. So yeah, definitely contact the super and find out what do you have and what is it that you have and what's the process of not cashing out fully, but at least making changes as you see fit.
Yeah. I suspect that most people that have a managed super fund, and we've gone from managed to self-managed currently in the process of doing that now. But I suspect that the mindset of most people who have a managed fund, they might have their own business, as we had or have,
Yep.
and had a managed super fund, and we were required to put the 9% or whatever it was in, plus with good advice, we would put lump sums in at the end of the year to manage exposure to tax and build wealth and all of that sort of stuff. But I just suspect, and I suspect this because this was my mindset as well, when you've got a managed super fund, it's being managed. And it just never occurred to me that I need to check in on a regular basis, and listen to someone like yourself and find out what's going on and have some level of influence on how well my managed super is doing, because we just think I've got super. What the hell does that mean? And as you said, it could be, in a growth fund, it could be in a balance fund, it could be in an income fund, and they all have different level of risks, but they all have different level of returns.
Yes.
And if they just sort of leave it where they leave it, because they're getting paid the same amount no matter what they do, you're the one that's being disadvantaged by that. So, do you recommend that you kind of slap yourself around a little bit and go, hey, I do need to do some level of research and have some level of input in my managed fund?
Oh, for sure, because, there's a difference between, if you do a simple compounding calculator between managed fund that gives you 6 or 7%, which is what a lot of supers do after fees, versus a fund that does 10, 12, 15%. It's a heck of a big difference. Short term, you don't really feel it. But long term, although it might be double or triple percentage-wise, over a period of 10, 15, 20 years, the compounding return is probably 10 to 20x the original capital that you would have put anyway. So you definitely want to make sure you do check it out, because there are 90%, this is just the stats, 90% of managed funds out there, including super, actually don't outperform an index fund even, let alone a fund that you manage yourself, because you know that you've got tools. But if they're not even after their fees, they're not even outperforming these index funds, what are you doing in the first place? So, definitely don't have that sort of out of sight, out of mind, because by doing so, you're going to look back and go, far out. It's always that word, I should have, I could have, but yet you didn't do it. So now, hopefully, this podcast, hopefully these warning signs, so at least check the super and then treat it almost like a habit. And it could mean just putting in a calendar every quarter when my statement comes in via email or via post, just check it out and see how it's going. And then just do, at least an annual review. And is it doing as it promised, or is it actually underperforming? And should I go elsewhere? And it doesn't have to be self-managed super. It can be at least potentially change into another fund that has lower fees or has done better and always look at long term, not short term. Like one year a fund can get lucky and do very good returns, but if they're 3 and 5 year rate, and I'd say 3, 5, and 10 year rate, I would say that's the sort of the yardstick that you want to look at, because when you change over, there's a bit of work, paperwork, and you don't want to be always switching and changing every year. You just want a fund that you trust, and you want to go there, and you can able to stay there until you feel you're ready to then go into a self-managed super, for example, after at least some education. Yeah, please don't. I always say don't ever go self-managed super because you think you can do better if you haven't been educated.
Yep.
Because you would, one, do worse, but two, potentially lose a bunch of money without even knowing what you're doing. So don't ever do that too.
Yeah. And I assume if you put your pencil to it, that's actually a digital pencil, but if you put your pencil to it, that if you invested, let's say, 24 hours a year, one day a year in learning and putting the effort in to contact the super fund, get the paperwork, make some decisions. And as you said, you might not be switching from a balance to a growth every year. It might be, 2, 3, 5 years, something like that. But you've got influence on it, and you invest, a day, a year with an hour here, there, and whatever. I suspect the hourly rate in the difference that it would make to the outcome in 25 years or whatever would be significant.
Thousands. It's thousands.
Thousands of dollars an hour.
Thousands of dollars per hour. Yeah. And I like, even with our training program, I say, look, if you don't, as long as you don't mind spending 20, 30 minutes a day, 5 days a week, it equates to about 5 hours. And in a year, you probably spend about, because there's only 200 trading days at a year anyway that the market's open, half an hour a day on average. I'm not saying that every day you do half an hour. Some days there's no opportunities. It might be 5 minutes. But on average, it's probably half an hour. So it's 100 hours a year. A lot of people will do 100 hours in 2 weeks easily. And if you run your own business, probably some people can get to 60, 70 hours a week. So that 100 hours over the entire year. But if that makes you a couple of $100,000 extra, that hourly rate on its own is still tremendous as well. So definitely you want to, the hourly rate compounded over time gets bigger and bigger as your fund gets bigger and bigger as well. So, when you start off small, it doesn't feel like much. But then when you get bigger and bigger and you scale and you add more to it and you get confident, then that hourly rate becomes bigger and bigger.
Yeah.
For sure.
I know, and we'll get to it in a minute, but I'll just throw it out there now so people lean into the conversation, that you've got some resources that you're going to share for anybody listening to this podcast. Because I'll bring that up because I think that answers the question to a certain extent when we're sort of encouraging someone who's got a managed fund. Well, but how do I make a decision as to go to a balanced or a growth or whatever? And, what am I looking at? You need to have some education for that. You need to have some resources. So we'll cover that in just a minute. But before we get there, what are the main points that you would like somebody listening to this podcast to go away thinking about, maybe deciding to do? What, major core ideas and actions that people you think they should be taking after listening to this conversation?
I think that the first core action I'd say is, if you already have a share portfolio, is definitely review the current share portfolio to know firstly what's in there, whether it's managed by someone or yourself. Have that action step to at least review your current portfolio, because we know that something major is happening on the downside. So you want to be prepared for that. So at least know what's in the portfolio. If there's rubbish, get ready to get rid of some rubbish and clean up the portfolio to make sure that if, when the time does come and then bad thing does happen, that you feel protected and you're confident that those shares, even though it comes down in short term, they'll bounce back up. Bad shares, however, will take a lot longer, or maybe never actually bounce back. So you want to do that. The other thing too is, then if you don't have any education, maybe get some, at least know what's going on. So then you don't get baffled by all the media attention that's happening right now about different technologies, AI, etc., which is all over the news anyway. And then that process that you've got allows you to not be swayed by the general public. So that's another thing. And I'd say that if you are looking at, haven't invested before, have not, and you're looking at investing, because we know there's going to be a correction down a track, get some education, be ready for it. Then when the time comes, if you're cashed up and you can take advantage of that once in 5 or 10 year opportunity, the returns that you normally get 10, 15, 20%, it's going to be outstripped, because buying things at half, when things have gone down by 30, 40% half price, it's like you going shopping, at Woolies or Coles when things are at half price, you want to buy more of it. Yeah. So you want to be prepared for that, because that would be I'd say one of the lowest risk investments you ever make, by buying during those times, because everything's just undervalued. And the moment you start buying, you'll be quite confident that they're going to go back up, basically. So that's the other thing. And then I think that the final point is what we just covered, the super. Definitely want to check out your super. Self-manage, either their shares. Please make sure you also review it, like I just said, either yourself or at least with an advisor. Make sure, however, the advisor knows what they're talking about, because there are a lot of advisors. That's why we've got about 100 advisors under our program. A lot of them just read reports. So hopefully when you speak to them, they understand shares and not just manage funds, because that's their job. They're there to provide managed fund reports and tell you which fund is good. So you want them to understand shares as well, and not just on a surface level, But if you are on a managed super fund, then what we said earlier is give them a call, find or get your statements, know what you've got, and at least review it. Look at the past performance. Look at what fund you actually have, and be a bit more proactive about it this year, because it's going to make the difference between a sleep, what I call a sleep at night factor, or being a spectator when the market actually drops, and then you see a decline in your super, and then you get all stressed about it down the track.
Oh, good stuff.
Mm.
So, as I was listening to that, you were talking about how to make decisions and check it out and all of that sort of stuff. But I think you need to know some fundamentals of what to look for. At least that was the blinding flash of the obvious when I first learned through your program. I went, wow, like it would be so easy to get sucked into, buying Uber. Shares in Uber at the time, because that would be a classic example of,
finally, we've actually, you talk about Uber. We finally bought into Uber because finally turned the corner. It's dropped by about 30%. But funny enough, either it's dropped by 30%, the financials are now profitable. They have not been profitable for so many years in existence. And now the last 2 or 3 years, there's history that they've actually turned the corner. They're actually making money because of, not because of Uber, the normal Uber, because of they're doing the deliveries of food and everything. So that's really where a lot of the money's now coming in, because everybody does that now. It's just so normal. So they've turned the corner doing that, and that's why we're finally looking to Uber. So yeah.
Well, I did hear a rumor, and you might be able to confirm or deny it. I did hear a rumor from one of our builders heard that Uber and Bunnings are having a conversation to potentially do building material deliveries, which would be awesome for builders. Like the amount of money that these guys waste sending guys to the hardware shop to pick up something that they've forgotten or what have you, or waiting for Bunnings or whoever to make the delivery, having an app on your phone, get that, bring it now,
and
confirm
Mick,
or deny. Do you know anything about it?
Yeah, no, Mick, that's not just one example. I know for a fact that in behind the scenes, they're already partnering up with, and they don't say this in public, but they're already partnering up with the likes of, obviously food like McDonald's, etc. But they're also partnering up with some pharmaceutical giants like the Chemist Warehouses.
Oh no,
potentially as well, because they're, rather than people who can't get to a chemist, for example, either from disability or whatever, they're actually being those guys don't want to create a delivery service because there's a lot of infrastructure, a lot of costs. So they'd rather partner up with someone who already has the infrastructure and has the drivers. So it just makes so much sense that these guys just partner up together. So it's not just the Bunnings, it's also other businesses that need delivery or want to have a delivery service but never thought about it because of the cost of creating it. But now these guys, the Uber, where the infrastructure is already there, why not just use these guys and partner up with them as well? So yes, it's happening behind the scenes for sure.
We're never going to have to leave the house. Like future houses are going to be designed without a driveway and just a delivery window.
Yeah, and that's bad too, because then everybody's going to get that by not moving.
Yeah, it's shocking. So I mentioned that you've got some resources for the people listening to the podcast. Fill us in.
Yeah, so a couple of things. One is I know a lot of your listeners are builders and tradies, so we've got a wealth guide for those who are in the building and tradie industry. So I'd love Mick to pass it on to you. Yep. And what I just thought about as well, didn't think about it, is if you're looking at wanting to select the shares, know what criteria to look at, we've actually got a free stock checklist that you can download from our website. So I'll give Mick that link as well. And so please do so, because that would eradicate 99% of all the shares out there around the planet, not just Australia, but around the planet, of all the rubbish, and you're just able to focus on the very best if you are looking at investing. And you can use the same checklist to, what I talked about earlier, to do a review of your own portfolio if you've got stocks already. So that, and then we've also next, I think in several weeks' time, we've also got a masterclass that's coming up for builders and business owners to also attend if you want to actually learn. And I do teach for that, a full 90 minutes, 2 hours of what you should be looking at and what you should be doing as well. So it is a lot of fun. You will learn a ton, and you just got to check it out because we've got almost 1,000 reviews about that on Google reviews at 5 stars. So check that out, and I promise you're going to not only learn, but you're going to actually enjoy that learning process too.
Yeah. And I can vouch for that. Been through the process, and I find it inspirational, enlightening. Like you go, that makes so much sense, and you feel like you're, that little bit smarter at the end of it, a bit more intelligent. But it is fun. It's not too serious. Great stuff to start to wrap your brain around because and this is just the way I look at it. As I said through the podcast, that the reason that the share market works and goes up and down is because of all of the emotional decisions, the wrong decisions. People are making wrong decisions time after time because they're not looking at the data. They're just making emotional decisions. That's why it fluctuates. And so you can be one of those people who understands what the data is and make more informed decisions, and you can have some fun doing that. So we will make sure we'll have all of those links to those resources in the description, and I really encourage everybody to get into it. It's great stuff. So thanks for being another repeat offender on the podcast, coming back and updating us with what's going on. It's always enjoyable. It's always fascinating. And I always walk away feeling that little bit smarter after speaking with you. So thanks very much for being on the podcast.
No, thank you, Mick, for having me. And always a lot of fun chatting with you and being able to share what I know with your tribe and having them also understand things a little bit better and not getting swayed by the markets and all the media as well. So great to be here.
Perfect. Thanks very much again, Terry. Bye for now.
You've been listening to the ToolShed. If this podcast struck a chord with you, make sure you spread the word by sharing it with your mates in the building industry. We love your help to make the building industry better for everyone involved.